Hello, my name is Luca Berenato, and this is my macroeconomics final project and presentation. The topic I will be talking about today is the relationship between economic growth and stock market returns. To introduce this topic, my topic explores the correlation between the performance of the stock market and the broader economic conditions of a country or region. This topic is very important because understanding this relationship can help investors make better investment decisions, and it can help policymakers design policies that promote economic growth and stability. The stock market is often seen as a barometer of the economy's health, and investors often look to economic growth indicators, such as GDP, as a way to gauge the potential returns of their investments. However, the relationship between economic growth and stock market returns is not always straightforward, and many factors can influence stock market performance. The purpose of this presentation and study is to provide valuable insights and analyses for investors, financial analysts, and policymakers to better understand the relationship between economic growth and stock market returns, if there is any. The general question that I'm trying to answer during this presentation is there a relationship between economic growth and stock market returns? We must first have some background knowledge of what the terms mean to figure out if the correlation between economic growth and stock market returns exists. First, economic growth is the increase in the production of economic goods and services, compared from one period of time to another. The most common way to measure this is using the gross domestic product, or GDP. The equation to solve this is GDP equals private consumption plus gross private investment plus government investment plus government spending plus exports minus imports. Like we learned in class, we used a similar equation. GDP equals C plus I plus G plus X minus M. Some factors that contribute to economic growth can be productivity, technological innovation, and investment. On the other hand, stock market returns are a profit, stock dividend, or both that an investor receives on one's investment. Stock returns are approximated by the market share price growth rate. Two measures of the stock returns are used: return on assets, ROA, and return on equity, ROE. Some factors that affect the stock market include company earnings, interest rates, and market sentiment. The simple answer to our main question is that there is no historical data that proves the relationship between economic growth and stock market returns. But some theories may explain this relationship. First, the wealth effect is a notion that when households become richer as a result of a rise in asset values, such as corporate tax stock prices or home values, they spend more and stimulate the economy. The dividend growth theory is a formula that investors use to determine a fair value for a company's stock based on the current dividend and expected future dividend growth. This next slide shows a case study done by MSCI Barra in May 2010 that studied if there was a link between GDP growth and equity returns. As you could see, growth expectations were overly optimistic and equity performance was negative, while the GDP continued to grow. We may think of stock returns as a result of the underlying real economic growth, but the study shows that the long-term real earnings growth falls behind long-term GDP growth in many countries over some time. The first article that we will be reviewing is by The Economist. Does economic growth boost stock market prices? This anonymous article points out the works of William Bernstein. The author says that Bernstein says that periods of technological change have not been good for stockholders. The booms of the 1920s and 1990s ended badly. The second quarter of the 19th century, the era of the steam engine, the railways, and the telegraph, was no better. The fragmentary evidence Mr. Bernstein cites suggests that returns on securities were less than spectacular. Historians of Britain's railway mania of the 1840s find that the social and economic benefits of the railways were huge. but investors did not do well. This just comes to show that in times of economic growth, investors do not do as well. The article also says that more growth means more profits. But as Mr. Bernstein points out, faster growth does not reliably translate into better returns. In periods of rapid growth, shares are issued at an even faster rate than the growth in earnings and dividends. The discounted part of the valuation equation must also be reckoned with. As many Buzzkill noted in the late 1990s, stronger GDP growth often comes with higher real interest rates. At one point, real long-term rates were 4% in America. That diminished the value of future cash flows. Over the broad sweep of history, returns have tended to fall as societies become wealthier. As economies grow richer, they generate more surplus capital. When societies become wealthier, returns tend to fall, and people become less impatient, leading to lower discount rates. In conclusion, the author cites a paper by William Bernstein, which argues that periods of technological change have historically not been good for stockholders, as faster growth does not reliably translate into better returns. The next article analyzed is also from The Economist and is called Economies and Stock Markets Do Not Always Match Up Well. Most of the growth in the world's GDP over the next 5 years will be in developing countries, says the IMF, International Monetary Fund. It is light on exposure to the fastest growing bits of the world economy, notably in Africa. Instead, it has a heavy tilt towards economies in the Asian supply chain to rich world consumers. The article concludes with a point that says that by owning a broad range of stocks, investors leave themselves less exposed to the specific company, industry, or country risks. The last article that we will be discussing is published by Forbes called Think the Stock Market is a Leading Economic Indicator? Think Again by Ivan Ilin. The article discusses the challenge of understanding the relationship between the stock market and the economy, particularly in the near term, where the stock market seems disconnected from any underlying economic frame of reference. The author analyzed data from the past 2 decades to show that using past performance to gauge where to allocate funds could be perilous. For instance, while the stock market saw a cumulative negative 4.74% return from January 1st, 2001 to December 31st, 2010, investing in almost any money market fund would have yielded better results. However, during the same period, U.S. corporate profits grew 144.5%, and GDP grew an incredible 46.84%, laying a foundation for future growth. The article concludes that the stock market eventually catches up to underlying economic conditions, and today's stock market prices are at limits of current feelings about the state of things, rather than a leading indicator of the future economy. In conclusion, there is a common belief among financial advisors and sophisticated investors. The stock market is a leading indicator of where the economy will be in the not-too-distant future. However, there's a challenge with this understanding because the stock market doesn't seem connected to any underlying economic frame of reference, especially in the near term. In conclusion, it is proved that there is no relationship between economic growth and stock market growth, which solves our question for this presentation. The implications of this relationship for investors, policymakers, and the broader economy is that there is no relationship, and we should not see these two terms as relatable. To promote economic growth, aggregate demand needs to be increased. There is nothing really to do to promote stock market growth since many factors decide this. It seems like many factors go into both economic growth and stock market returns, which is why this is challenging to see the relationship between the two terms. Here is my works cited page. Thank you.